Hey everyone, welcome back to Corporate Decoder. Man, this latest Omgen report is a spicy one. It looks like they went from precision medicine to, well, something else entirely. Let's dive in. Alright, so this is a quarterly report, a 10Q filing from Omgen Incorporated. It gives us a snapshot of where the company stands financially for the period ending the 30th of June 2025. Now, Omgen actually used to be a precision medicine company. They were developing tools to help doctors fight infections, especially those nasty multi-drug resistant ones. But then in November 2023, things took a sharp turn. Their European subsidiaries in Germany and Austria filed for insolvency. This basically meant Omgen lost control of them, and they had to stop including them in their financial reports. Let's look at their balance sheet. As of the 30th of June 2025, they had about $831,000 in cash and cash equivalents. That is down from over 1.3 million at the end of 2024. So their cash pile is shrinking. But check this out, their accounts receivable jumped dramatically from just under $30,000 at the end of 2024 to over $4 million by June 2025. This is a huge change, and we need to see what is going on here. Overall, their total assets grew from about $9.8 million to over $13.2 million. That increase is largely driven by that jump in accounts receivable and a new intangible asset. On the liability side, their accounts payable went up a bit, and their short-term insurance financing also increased significantly. Total liabilities are pretty stable, around $2.5 million. Now, this is where it gets interesting. Their stockholders' equity shot up from about $7.3 million at the end of 2024 to almost $10.7 million by June 2025. This big jump is primarily due to the company's accumulated deficit shrinking. Remember that accumulated deficit is basically the total net losses the company has had since it started. It went from a negative $293.5 million to a negative $290.3 million. So they are still losing money overall, but the gap is closing. Let's move to the income statement. This is where the story really unfolds. For the second quarter of 2025, their total revenue was $4 million, a massive increase from just $28,000 in the same period last year. How did that happen? Well, it is almost entirely from listing sponsorship services. Their old revenue streams like product sales and laboratory services have completely disappeared. Zero revenue from those in 2025. Their operating expenses also dropped dramatically, from over $1.5 million in the second quarter of 2024 to just under $600,000 in the same period in 2025. This is largely due to scaling down their old operations. And this is the big news. They went from an operating loss of over $1.5 million in the second quarter of 2024 to an operating income of over $3.4 million in the second quarter of 2025. That is a complete turnaround. They also had a nice increase in interest and other income, which helped boost their overall result. As a result, they reported a net income of over $3.5 million for the second quarter of 2025, compared to a net loss of over $1.5 million in the prior year. This is a huge shift. Basic earnings per share went from a negative $1.18 to a positive $0.35. That's a significant improvement for the shareholders. Looking at the statement of stockholders' equity, we see how these changes played out. The big increase in equity we saw on the balance sheet is reflected here. At the start of 2025, they had about 10 million shares of common stock and a significant accumulated deficit of over 293 million. They had some stock compensation expenses, which is pretty typical for companies. And by the 30th of June 2025, their net income for the 6-month period was over $3.1 million, completely wiping out some of the accumulated deficit. Their total stockholders' equity is now positive, sitting at over $10.6 million. This is a massive improvement from being in a substantial deficit. Now, for the cash flow statement, this shows us where the actual cash is coming from and going. For the first 6 months of 2025, they used about $645,000 in operating activities. That might sound like a lot, but it is much better than the $1.8 million they used in the same period of 2024. The big jump in net income helped here, but the large increase in accounts receivable used up a lot of that cash. Remember that $4 million accounts receivable increase. That is likely why their operating cash flow looks a bit squeezed now. Financing activities provided about $166,000 in cash for the first 6 months of 2025, mainly from short-term insurance financing. In 2024, though, they got over $820,000 from financing, mainly from preferred stock issuances. So what is the story here? Omgen has completely pivoted. They sold off their old precision medicine business and are now focusing on financial services and technology. They formed a new subsidiary called Capforce International Holdings Limited, Force. This new venture is all about listing sponsorship and consulting services for companies wanting to go public. They are also planning to get into fintech and digital investment banking. This pivot seems to be the reason for that huge revenue jump and the return to profitability. They got that big chunk of money in business from AI Capital Limited and David E. Lazar through various stock deals and purchase agreements. It looks like AI Capital Limited is now the major controlling shareholder. Remember that big jump in accounts receivable? Well, according to their notes, it is because a large chunk of their revenue in the second quarter of 2025 came from equity in a client's company which they have not yet received in cash. They are valuing that equity at $5 million. This is a very unusual way to recognize revenue, and it carries a lot of risk. If that client's IPO does not go as planned or the valuation is lower, Omgen could lose a lot of value. Now, the company does mention they have cash and the ability to sell more stock to AI Capital Limited if needed, which they believe will allow them to operate for more than 12 months. However, they also mentioned that their stock was delisted from Nasdaq. That is a big red flag for investors and can make raising future capital much harder. They also still have some Series D preferred stock that a single investor has not fully paid for. This is a bit of a lingering issue. Okay, so my take on Omgen. This is a company in complete transformation. They've essentially ditched their old business to chase a new one in fintech and capital markets. The good news is they've turned a profit on paper and dramatically cut down on their old operating costs. The big story is this new listing sponsorship service that is driving all the revenue. However, there are significant risks. The $4 million in revenue recognized in the second quarter is heavily in the form of equity in a client company, which is very volatile and not the same as cash in hand. Plus, their stock is no longer on Nasdaq, which makes it less accessible for investors and signals potential issues. Their future success hinges entirely on the success of this new venture and their ability to manage the risks associated with that equity-based revenue recognition. They are relying heavily on AI Capital Limited for any additional funding needed. It is a high-risk, potentially high-reward situation, but the path forward is far from certain. Alright, that is our breakdown of Omgen's latest filing. What do you think about this massive company pivot and their unusual revenue recognition? Let me know your thoughts in the comments below. If you found this analysis helpful, please give this video a like and subscribe for more deep dives into corporate filings. And for more behind the scenes discussion and to connect with other finance enthusiasts, check out our Discord community linked in the description. Thanks for watching, and I'll see you in the next one.